The yield on the 30-year US Treasury bond is currently 5.1%. That number sounds boring, but it's not. The last time it traded this high was in July 2007, 4 months before the financial system began to collapse. A 30-year bond is a loan. You give the government money today, and it promises to pay you back within 30 years. When the interest on that loan rises so high, it means lenders think the risk is increasing. And now, all of that risk is concentrated in one word: AI. A 30-year bond works like a simple promissory note. You lend, they promise, decades pass, you get the debt. It's that simple. But look what's happening on the other side of the economy. While that bill is getting more expensive, 4 companies, Microsoft, Amazon, Google, and Meta, are set to spend $725 billion on AI infrastructure in 2026 alone. That's a 77% increase from last year's $410 billion. $725 billion is more than the entire annual GDP of Sweden. 4 companies, 1 year, 1 bet. Let me introduce you to a company that shows you exactly how this bet is built: Oracle. Not the brightest name in the tech industry, but the one with the sharpest blade. Oracle has about $100 billion in debt, and in early 2026 it announced plans to raise up to $50 billion more, both in debt and equity, just to keep building data centers. Why does a database company need $50 billion? Because Oracle has signed a deal to sell OpenAI cloud computing capacity worth hundreds of billions of dollars. To provide that capacity, Oracle must first build the data centers, and to do that, Oracle must first buy Nvidia chips. Oracle is borrowing money today, promising that OpenAI will pay it back tomorrow. This is where it gets interesting. OpenAI doesn't have that kind of money yet. OpenAI is projected to lose about $14 billion in 2026, nearly 3 times as much as the previous year, even though the company tells investors it will reach $100 billion in revenue by 2029. So Oracle is borrowing real, current, immediate debt against a revenue promise that will come in 3 years and has not yet been fulfilled. Now follow the money in a circle, because this is the part that traditional financial shows barely explain. Nvidia has announced that it is investing up to $100 billion in OpenAI. OpenAI is using Nvidia money and money from contracts, such as the Oracle deal, to buy computing power that runs on Nvidia chips. Nvidia sells the chips to Oracle and Microsoft, who then bill OpenAI for their use. OpenAI is paying with money that came in part from Nvidia. Some analysts call it a supply locking strategy. Critics call it something else: circular financing, where the same dollars are counted as revenue 2 or 3 times as they change hands. Bernstein research analyst Stacy Rasgon said after the Nvidia OpenAI deal was announced, "The deal raises real questions about why a chipmaker needs to finance the purchasing power of its customers." Oracle isn't even the most daring example of complex accounting in this development. Look at Meta. In October 2025, Meta took out $30 billion for a single data center in Louisiana called Hyperion. Rather than borrowing the money directly, Meta created a separate legal entity, an SPV, and invested only 20% of its equity. A private credit firm called Blue Owl covers the other 80%, and $27 billion in actual loans came from asset managers like PIMCO, BlackRock, and Apollo. This SPV owns the data center. Meta simply signs a lease and pays the rent. Meta's official balance sheet simply doesn't show the $27 billion in debt. It's reserved in a separate company that Meta doesn't own outright on paper, even though Meta is the sole reason the data center exists. It's an AI-era version of the off-balance sheet trick. The debt is real, the building is real, the risk is real, but the accounting shows that it's not Meta's problem. Multiply that structure by the industry, and you have a number that credit analysts are now watching closely. Private lenders have gone from almost 0 AI-related loans to more than $200 billion in just a few years, and Morgan Stanley is predicting another $800 billion in data center financing over the next 2 years alone. Some of these loans have their own warning sign. They're called PIK loans, or payment in kind. Instead of paying interest in cash, a company is allowed to simply add interest to the total amount of debt and payments it will be released later. S&P Global expects this type of debt, which is tied to weaker borrowers, to grow from $56.6 billion in 2026 to $215 billion in 2028. PIK loans exist for one reason: the borrower doesn't have enough cash to cover the debt right now. It's the financial version of paying off your credit card with a second credit card and hoping that the bill will grow more slowly than your income eventually. In early February 2026, this whole structure cracked for a moment, revealing what was underneath. The Wall Street Journal reported that Nvidia's $100 billion investment in OpenAI had been halted. Oracle shares fell that same day. Not because Oracle did anything wrong. Oracle stock fell because the market suddenly remembered that Oracle had already spent money, already signed leases, already ordered chips, based on a funding round that hadn't actually closed. Sam Altman wrote on social media that the relationship with Nvidia was healthy and long-term. That didn't stop the sell-off. One deadlocked negotiation between two companies affected the stock price of a third. This is not a healthy market that reacts to news. This is a market that knows how thin the ice is. This is the part that the evening news skips because it doesn't fit in 30 seconds. The AI story is really not about chatbots anymore. It's about the structure of debt. When Oracle borrows $50 billion to build a data center, and the contract backing that loan is contingent on a startup losing $14 billion a year, effectively growing tenfold, that debt is packaged, sold, and distributed through the same pension funds, mutual funds, and 401ks that ordinary people have. You don't have to own Nvidia stock to be exposed to this. If you own an S&P 500 index fund, you already own it. The top 10 S&P 500 companies now account for 43% of the entire index, the highest concentration on record, more than during the dot-com boom of the late 1990s, when that number reached nearly 27%. Almost half of your diversified retirement account is actually a bet on a handful of AI infrastructure companies, whether you chose to bet on them or not. Here's the mechanism that no one explains on TV. Index funds are forced buyers. When Nvidia, Microsoft, or Oracle stocks go up, every fund that tracks the S&P 500 must automatically buy more of the stock, by default, regardless of price. That drives up the price even more, which forces the funds to buy even more. It's not investors deciding whether these companies are worth more. It's math running on autopilot, using your retirement money as fuel. And the autopilot doesn't ask whether OpenAI's promise of $100 billion in revenue by 2029 is realistic. It just buys. So imagine the chain again, with names added. The 30-year bond yield is rising to 5.1% as lenders want more risk protection. Oracle is borrowing $50 billion anyway, because it has already promised OpenAI power. OpenAI is losing $14 billion this year, promising $100 billion in future revenue. Nvidia's money is helping OpenAI pay Oracle and Microsoft, who then buy more Nvidia chips. And your index fund is on autopilot, buying Nvidia and Microsoft stocks no matter what, because the rules say so, investing 43% of its market value in companies